very excited to have Joseph Wang on. For those of you guys who were at Limitless, he was our keynote. And for those of you who might not know, Joseph worked with the open market desks at the New York Fed. He's one of the traders there, knows what the Fed is doing, and has analyzed them and spoke about this at our conference last June. Welcome back, Joseph.
Hey, thanks so much for having me. It's great to be here. Great to see you again.
What's your crystal ball say for 2024?
I will note that getting this right is really hard, so that's why there's such a large range of opinions, right? The Fed has been pretty wrong over the past few years, saying, inflation is transitory and so forth. So there's a lot of moving parts here. What I would first do, though, is let's take a step back and think about how we got to where we are. So a year ago, as we know, the Fed said that they would begin to aggressively raise interest rates, which they did. Chair Powell went to the famous Jackson Hole speech and told everyone, yeah, I'm going to raise interest rates, inflation's too high, and there's going to be some pain. So that's what everyone was expecting. Rates are going to go higher, we're going to have a recession, unemployment is going to go up, but hey, we'll get inflation under control. That was everyone's mental model, and that was totally reasonable. But as we know now, with the benefit of hindsight, really not much of that happened. So the Fed did, true to their word, raise rates aggressively, right? So short rates are above 5% now, close to 5.5%. But at the same time, if you look at economic data over the past year, so we grew 2% first quarter, 2% second quarter, and most recently, now this is going to sound really crazy, but first, the data shows that we grew at 4.9% third quarter, but today the data was actually revised higher, saying that we grew at 5.2% real GDP growth. So it looked like that the Fed raised rates aggressively and the economy actually accelerated, which is bizarre, but that does seem to be what happened. At the same time, unemployment rate remains around multi-decade lows, and at the same time, inflation has been steadily trending lower. It's still rising at a rate that is too high, but it's been rising at a slower rate. So basically, the Fed raised rates, tried to get inflation down. Inflation did come down, but it didn't really seem to come down the way they thought it did. What seems to be happening is, as you note, Ken, it seems that we really are in a soft landing because inflation is coming down without the economy going into a recession. Now, that's how we got to where we are today. Now, today, though, I think there's been some really big moves from the Fed and in the markets that can give clues as to how next year will unfold. So the first thing that I would note is that over the past week, the Fed has been sending pretty strong signals that, inflation has been coming down a lot. There's no recession. Maybe we don't actually need to have a recession to get inflation lower. So they seem to be open to cutting rates sooner than the market expects. So, a month ago, the market was saying the Fed is going to stay higher for longer and not cut rates until maybe the second half of next year. Today, the market is pricing in a 50% chance that we could have rate cuts as soon as March. And so that's having a big impact throughout the financial markets. You can see the 10-year yield declining significantly from as high as 5% just a month ago to now looks like it's 4.3%. And so that's the equity markets, of course, are responding as well. So that gives me comfort that next year, I think, will also be a pretty good year for the economy, simply because there's a lot of ammo left that the Fed can do. So interest rates are at 5%. Next year, if we slow down a bit, the Fed could cut rates, and that could provide some boost to the economy such that, I think next year is going to be, I don't think we're going to have a hard landing. We might have a small recession later on in the year, but I think my view today is that next year is going to be fine. It's going to be modest growth.
So when you say that they could cut rates in March, I think that the rates went up so quickly, people kind of assume they're going to go down just as quickly. So when you say they can start cutting rates, do you anticipate them cutting rates multiple times next year and getting us down a lot further, or being more conservative about that?
So I think we could cut rates probably maybe 3 or 4 times next year. Again, this will have to depend on the data. So this is how I think about it. Maybe that would be more helpful. So the Fed is looking at the world through the lens of real interest rates, right? So they're looking at nominal rates minus inflation. Now, as inflation trends lower, they want to make sure that nominal rates also decline so that real interest rates, which are nominal minus inflation, stay at around the same level. Now, we've seen inflation steadily come lower. Right now, we're about 3.5%. Let's say inflation goes to 3% next year. Now, if we want to keep real rates at around, let's say, 2% or maybe less, depending on where the economy is, and we could easily have room to cut 100 basis points or more. But I would say that 100 basis points. So my base case is maybe 4 rate cuts next year.
So like 1% lower.
Yes,
essentially.
exactly, 1% lower.
But I always look at shelter and of course food are two big things that the Fed is still kind of chasing in that CPI model. And I'm wondering, it certainly looks to me like we're heading into a pretty good supply shortage of homes. And the demand is uncertain at this point. But one thing that's for sure is that the supply of homes in the next few years is going to be significantly lower because of the cost of a home, the cost to buy a home, and then, of course, people are locked in at these 3 and 4% rates. And so they're not going to trade out something when their mortgage is a lot more. So what do you think the Fed's going to do around, because I think last I looked, shelter was somewhere in the mid-40s of the CPI number. It's a pretty big number. When you take a look at inflation, do you consider all those nuances?
Well, Ken, I'm going to be honest. I think you have a much more sophisticated view on this than the Fed does. So the Fed will look at this and, they have one tool. It's interest rates, right? And so they will look at it from a demand perspective. From their traditional thinking, well, we got inflation, we got to hike rates because that will cool down demand. I think there's a lot less thinking that goes into it, whether or not raising interest rates will also reduce supply, because as I've heard, when you have very high interest rates, if you're a builder, that makes it more difficult for you to go and get projects because the numbers are more difficult to pencil. So I guess if you keep interest rates very high for an extended period of time, you could constrain the supply of new construction, ultimately causing more inflation. So I think that, and not just for housing, but if you have any capital-intensive industry, let's say you're building a big factory, I would imagine that higher costs of capital will also decrease your willingness to build factories and thus restrain future supply, ultimately increasing inflation through that reduction of supply channel. Now, I don't actually think looking through Fed statements and listening to Fed speakers, I don't actually think they look at the world that way. If they did, it'd be quite difficult, right? Then they would see inflation. That would mean that I have to cut rates, which actually would be not what they want to do, not what they traditionally would do. So there's a lot of nuance there that I don't think they take into account of. And it is totally possible that the supply response in some industries through higher rates could hurt the supply response even more than reduce demand, making inflation worse for some industries.
What's your position on, is our dollar going to get weaker or is our dollar going to get stronger? Because I hear some very smart people with very compelling thesis on this topic, and I'm super confused.
So I'll give you what I think will happen, but I would look at the dollar strength in two ways. One is, how strong is the dollar against other currencies, let's say the euro or the yen or something like that, and how strong the dollar is when it comes to, let's say, purchasing goods and services, and that is to say, inflation. Now, as you correctly note, what the U.S. government is doing is just crazy. They're just printing and printing more and more treasuries, printing stuff to buy goods and services. That's basically helicopter money, and that is not good for the currency. Right now, the budget deficit is about 7%, and that's unheard of in a time when economic growth is positive. You can see that during war times, you can see that during depressions, but you really shouldn't be seeing it when unemployment rate is at multi-decade lows and the economy is growing fine. But that's the trajectory, and I don't think that's going to change. I was just talking to Professor Barry Eichengreen yesterday on another podcast, and he's done some really interesting research as to whether or not it's likely for a country to rein in their deficit. And what he found, looking across many countries, is that the more polarized a government is politically, the less likely they're going to get their deficit under control, because in order to get the deficit under control, you need, let's say, broad agreement and broad unity to take these hard steps to make these cuts. We don't have that today and probably won't have that in the near future. So this deficit is probably going to continue for the next few years, and that should be, in theory, very negative for the dollar. When I look at that, though, I would focus more on the negative when it comes to purchasing power, that is inflation. So that makes inflation, I think, structurally higher going forward than it is in the past, which would be great for assets, real estate, for example. But when you're thinking about the dollar compared to other currencies, the euro, the yen, Aussie, and so forth, that's a whole nother story, because that's more of a comparison between what the US is doing with all its strengths and its faults against other countries. And when you look at it that way, I think that even though the US is not being managed very well, I look across the world and I think those other countries aren't doing that great of a job either. So it's much less clear to me. What is clear, though, is that the US is the reserve currency, has a lot of natural strengths to it. I mean, being protected by two oceans, giant military, of course, continues to own the global payment system, which is in dollars. So I think that going forward, I don't think that the current US dollar will weaken against other countries. In fact, the next time we have a bout of, let's say, geopolitical risk, and it does seem like that's escalating, I think that's going to be good for the dollar. It's going to be more of a global safe haven. So
How, you were at the Fed for a long time, and you watched all the politics that can happen around an election. What do you think will happen and when as we head into this election cycle? It's really just next year.
I think that's the right question to ask, because I think the Fed is becoming more and more political. So we often think about the Fed as a central bank, monetary policy is independent, they do their own thing. Now that's all nice in theory, but in practice, if you look at the history of the Fed, that hasn't always been true. For example, during World War II, the Fed's job was to finance the government, right? They did yield curve control. Or you can just go back a few decades. Now, Nixon appointed his new chair, and he was like, I hope that you do monetary policy independently, but I hope that you independently come to the conclusion that my conclusion is correct. So, the history of monetary policy is sometimes it's more independent, sometimes it's less. I'm getting the sense that we are moving towards a world where it's going to be less independent. I think this because I look at Chair Powell. He goes to Congress and he gets grilled. Congress says, so we're spending a tremendous amount of money. Do you think that's inflationary or not? Obviously that is, right? But you can see Chair Powell just kind of dodging around, staring at his feet and so forth. He doesn't feel comfortable enough to say something that's so simple. His predecessors, say Chair Volcker, easily said that because it's obviously true. If you look across the pond, you look at President Lagarde at the ECB, she's saying that all the time. She's saying that if you keep spending, I can't get inflation under control. In the US, in the central bank today, they don't feel comfortable enough to say that. That tells me that central bank independence is going away. And so in the future, they're going to be more influenced by whoever's in the White House, whoever has more political power. So that's something to keep in mind if you're thinking about inflation, interest rates going forward. Now, I don't think they're going to do anything differently just heading into an election year. I think commonly people think that, the Fed doesn't want to try to tip the scales in one side or another. But I don't actually think that that's true historically. So I don't think they'll act differently next year. But I think whoever's in the White House is going to have more influence over monetary policy simply because that's the trend.
Joseph, thank you. I've learned a lot. What is the best way people can reach you? By the way, I love your new YouTube channel. I know it's not new, but I love your weekly updates. I know they can reach you at www.fedguide.com, but now you've got a lot more ways that people can watch your stuff.
Yeah, well, thanks so much for having me. It's a pleasure to discuss with you. I know I learned a lot about the troubles in the construction industry and how we could potentially have higher rent inflation just a few years down the line. I think that's really, really important. If you're interested in hearing more about my thoughts, as you noted, every week I publish a weekly video on my channel, Joseph Wang, where I talk about my thoughts on the markets. So if you guys are interested in that, please check it out.